Hey guys, welcome back to another video. Today I'll be talking about going public in Canada and the IPO process for either mid-sized, large businesses in the Canadian space. Being based in Toronto, Ontario, I am interested in the underwriting business as I work in finance, and it can be quite a complicated topic, and I would recommend that if you are considering doing that with your business, as always, please consult the necessary legal and financial advice that is needed, but this will provide a quick overview of that entire process. So let's get started. The decision to offer equity securities to the public through an initial public offering is one of the key decisions faced by an established business in Canada. The process and regulatory requirement require a lot of attention by the business's stakeholders, with input from investment bankers, auditors, and lawyers, all playing an important role in the overall process. Now, let's put things into perspective. Imagine that you are the founder and CEO of a mid-market shoe company based in Toronto, and I am your CFO. You own 65% of the business, I own 20%, and our business partner, who is retired, owns the remaining 15%. The share breakdown is as follows. The CEO owns 6.5 million shares, I, the CFO, own 2 million shares, the retired partner owns 1.5 million shares, for a total of 10 million shares in the business. So let's go through the entire IPO process. From the very start, you have to be clear on whether you want to list your company. It's a decision that you should be considered in both financial and psychological terms. The decision can take years to make, and even the best in the industry, Goldman Sachs, once struggled to find the right time. I've read quite a lot about Goldman Sachs and its history across the past few months, and I'm always fascinated by its kind of IPO process in the years before they listed the company, because they were struggling to find the right time, the right market, and set up the right incentive structure for them to go public. And so it actually took them about 6 years in total to finally make the decision that, yes, now is the right time to go public. So even companies like that who are very well versed in that industry will struggle with this decision. So some of advantages of going public are immediate equity capital, liquidity for existing shareholders, improved opportunities for future financing, increased prestige and a higher profile for the business, improved ability to acquire or divest businesses, clarity on business valuation and therefore an indicator of performance for the future. It can attract and retain talented management because you now are able to offer equity ownership in that company, and improved succession and estate strategy, especially when it comes to stock dividends, where you have a founder who has poured his entire life into starting up this company and all his wealth is tied up in that company. And to liquidate, he would either need to pay himself a stock dividend by raising debt or listing the company and really increasing the ability to really provide liquidity for his existing ownership in the company. And so that's very beneficial. Now, some challenges in going public are loss of control, the sharing of success with outside investors, a loss of confidentiality, incurring of listing and compliance expenses pre-IPO and after, a loss of flexibility because you now need to meet the expectations of outside investors, increased accountability and pressure, which can force a lot of leaders who may not have felt that pressure before into bad positions, and unwanted publicity related to internal disputes that might arise before or after. Okay? Now, before even reaching out to the underwriter, which is the entity which raises the capital, two goals need to be focused on in the months and even years before we become a public listed company. One is developing the appropriate reporting and control systems, which essentially means that for a lot of private companies, the decision-making process and how you decide on whether to take on a client or invest in something is very informal. At the end of the day, you have the founder and his friends who have really climbed up the ranks and worked along him for several years, and that decision-making process does not weigh a lot of the external risks. And when you are bringing in outside investors, they'll look at that decision-making process and they'll be like, hey, we need to change that. So to be proactive, you can change that yourself before you even consider speaking to an underwriter. You spend a few years before and you practice that decision-making process, setting in the right processes, following them step by step, and seeing who is able to, and empowering those people, and who isn't, and then really demoting those people or pushing them away from leadership positions. The second is developing the corporate image of the firm. And this is important when you are on the road and you're really kind of promoting the company to investors or improving the awareness of your company's brand in the market. And that really takes a lot of time. This is a mixture of both marketing and corporate identity in the sense of what values the company stands for. But once again, being proactive before you reach out to an underwriter will save you a lot of headache once you do become listed. Okay, so the following factors should be considered when you do reach out to an underwriter. The first one and most important one is the reputation of that underwriter, the distributional capacity, specialization and experience in the respective industry that you are in. In our case, it would be the shoe industry. Does the underwriter have a research department, which could then initiate research coverage on our company and therefore, kind of like provide additional information to investors? Can it provide further advisory services, which could foster a longer-term relationship? And can it contact and judge previous customers of the underwriter? So that essentially means that, we're referring to previous customers of the underwriter. We're talking to them about how they went through that process. Was the company very helpful? Were they rushing it? Was their money worth it? Because at the end of the day, we're going to have to pay this underwriter a large sum of money if we are going to list our company, and we want to make sure that we're picking the right one. So there are a lot of factors that need to be considered. And this can either be through consulting services, or you can make this decision on your own with your internal processes, which we talked about before. Okay, so once the non-disclosure agreements, the NDAs, have been signed, talks about valuation and how the underwriter sees the pitch to investors becomes very important. At the end of the day, you need to determine how much our company is worth. Where do you think demand will come from? Will it be only retail investors? How about pension funds and mutual funds? Do you see us as a viable investment? These are all important questions that you need to ask the underwriter. And in our case, let's assume that we take on GMP Capital and their underwriting services. We decided that because they have a lot of transactional experience in the Canadian shoe industry and have worked with some of our competitors and listing them public, we feel that they are the right company for the job. And at the same time, they have a research department which is comfortable in analyzing and researching our company and making the decision that, yes, we are a viable investment opportunity for both retail and institutional investors. At the same time, we talked to them and we said, okay, you know what? Can you get in touch with some of your institutional contacts? Can you gauge to see if there's a little bit of interest? And they did, and they told us that yes, this might be the right time, and therefore we proceeded forward with them. And at the end of the day, the most important question is how much we are worth. How much can we list our company for, and then decide, okay, do we need to, take some time to then go back to the company, change a few things so that we can increase the value of that company, or are we comfortable with listing it at this initial level? Okay. So now we're working with the underwriter. Now that you have an underwriter and have brought on the additional counsel of accountants and lawyers, you need to prepare the necessary documentation to proceed with the listing. The key steps are 1. Prepare a business plan. 2. Prepare audited financial statements. 3. Make any necessary modifications to corporate structure. 4. Appoint independent directors, and their responsibilities within the Canadian space are duty of care, which means that they are careful and are acting in the interest of shareholders, and they have a fiduciary duty to disclose any information that is important and relevant to investors. Number 5 is prepare and renew contracts with any existing customers or vendors, and establish share incentive plans for our existing staff. So there's a lot there. Let's kind of slow down a little bit and talk about each step. So we have step 1, which is preparing a business plan. Essentially, in the underwriting process, the company wants to know a lot about you so that, they can really initiate research and they can really conduct a full analysis of your business and generate a great valuation metric. And that means that we need to prepare a business plan so that we can show both any regulators and interested parties and our underwriter to become more familiar. At the same time, we need to prepare audited financial statements. We have to make any necessary modifications that weren't made before. And if you are proactive, then you can skip over this step because you've already made those decisions and those modifications. You then have to go and reach out and figure out, okay, who are going to be our board members? Who are going to be the representatives? Who are going to make the big macro decisions for our company? Then establishing and securing the contracts that are necessary to ensure that, our business is protected, at least in the short term, as we come on to the market. And then finally establishing the share incentive plan, which is a lengthy process that you work with the HR department. Okay, so an important question is Treasury or secondary offering. So once engaged with underwriters, a key question is whether you as the owner and majority shareholder want to dilute current ownership or sell existing shares. A Treasury issue is when new shares are issued for cash to the public. A secondary issue is when a portion of the shares held by existing shareholders are offered for sale and the proceeds accrued to such shareholders either immediately or on an installment basis. Okay? As new shareholders often prefer to fund the company and its efforts rather than provide liquidity to controlling shareholders, secondary participation is usually limited to some extent. In addition, escrow limitations might impact the breakdown between Treasury and secondary issues. Consider the June 8, 2017 IPO of MedRelief Corp. If you look at their term sheet, which I've provided in the video description, of the $100 million offering, $80 million was Treasury, which means they're new shares that are being issued now, and $20 million was a secondary offering from existing shares that were held by the executive team. And this is a relatively common breakdown of 80-20, 80% Treasury and 20% secondary offering, okay? So let's look through some equity breakdown examples to kind of give you a better perspective of this whole Treasury and secondary offering, okay? So case one, we have a retired partner, which one has 1.5 million shares, wants to cash out. So our secondary offering makes up 100% of our offering. And so our secondary offering is 1.5 million. Now this is unrealistic because usually, escrow limitations will limit us from really offering only secondary. But in this case, our CEO still holds 6.5, I still hold 2 million. And now that 1.5 million is transferred from the retired partner to outside investors. The problem with this is, from a ownership perspective, from a percentage perspective, nothing changes. The amount of shares in the business, nothing changes from that case. But the thing is, that retired partner cashes out and takes that money away. So us raising money is never an interest in this scenario, because at the end of the day, what we're doing is we're offering the secondary offering, and all that money is being taken out of the business to provide for the lifestyle of that retired partner. And that's the thing with Treasury versus secondary. Secondary essentially means that you're giving money to the executive team to then walk away, provide that liquidity for their shares. They're not going to put that money back into the business, because that's why they're taking that money out, having that desire to receive this liquidity. Whereas with a Treasury offering, you're ensuring that the money that is raised through that Treasury offering is going directly to the business. It's going to increase the amount of cash and equivalents on the balance sheet, and therefore provide liquidity for future investments and growth of the business. So in case two, no one sells, and it's a full Treasury offering. So we have a Treasury offering of 3 million shares, so 100% Treasury. In this case, the CEO, CFO, and retired partner all keep their number of shares. And now we introduce outside investors with 3 million new shares. So the total share count increases from 10 million to 13 million, and the percentage breakdown changes. Now the amount that is owned by the CEO declines, the amount that I own as the CFO changes, the retired partner also drops, and outside investors own a considerable amount of 23% of the business, right? But now with that, we raised $30 million in cash. If, say, for example, we did price it at, $10 a share, right? So 3 million shares at $10, it will give us $30 million in cash, and that's helpful for the business. Now, usually what's most common is there's a mixture. So the common 80-20 breakdown in case 3, where there's a Treasury offering of 2.4 million shares, 80%, and a secondary offering of 0.6 million, 600,000 shares at 20%, right? So the retired partner wants to really, cash out his shares. So our share account as the CFO and the CEO does not decline, but he decides that as a retired partner, he wants to get out of the business. And so the secondary offering, that 600,000 shares, it provides a little bit of a cash out for him. So his share count drops by 600,000, and the outside investors pick up the remaining, 2.4 million, right? And so what happens now is that, we raised a total of 24 million, so less than the 30, but more than the full cash out of the partner, and the overall share count increased by a significantly less, okay? So that's quite important to understand, especially when you're looking at the decision to see whether a business wants to do a higher treasury or lower treasury offering and increase the amount of secondary offering. Okay? So now the prospectus process. Going public generally requires the preparation of a disclosure document called a prospectus, containing all material information concerning the business and securities to be offered. A prospectus typically includes audited historical financial information, 2 years of balance sheets, and 3 years of income, cash flow, and changes in equity statements. There are also related management discussion and analysis (MD&A) documents outlining the business, its functions, and outlook, which need to be included in that prospectus. The objective of the prospectus is to provide investors with complete and accurate information about the affairs of an issuer, thereby enabling them to make informed investment decisions about the securities being offered. It requires the issuer to disclose matters like its corporate structure, its use of proceeds, its financial statements, risk factors relating to the business, significant acquisitions, and any other material facts relating to the security. Okay? Once the decision to go public has been made, an issuer must file a preliminary prospectus, a much smaller package, which will be reviewed and commented on by the Ontario Securities Commission, the OSC, and if the OSC, its principal regulator, or the OSC and its principal regulator in other cases. So after a preliminary prospectus has been filed, the waiting period commences. Historically, Canadian securities laws only expressly permitted for the distribution of the preliminary prospectus or the solicitation of expressions of interest from prospective purchasers during the waited period. While such distributions are still permitted under the 2013 amendments, dealers may now also distribute standard term sheets and marketing materials. A lot of words on this slide. To simplify it, essentially the prospectus process, before you really create this full document, which really includes everything, you pull the audited financial statements, you pull in a general summary of the business, and then you provide this information to the OSC, the regulator, and then you ask them, yes, we're interested in going public. Can you review our prospectus and determine whether we are allowed to? At the same time, while we are waiting for that permission to be approved, we can also then take a term sheet, and I've provided a term sheet and a link in the video description where you can see a term sheet with regards to med relief. And so that med relief term sheet is then taken, and the underwriter goes to institutional investors and retail kind of conferences, and they kind of like share this information with them just to gauge interest, just to see are these investors really interested in buying some equity? And if they are, then that's great. If they're not, then okay, we're going to back off and wait for a later period. But this is done as we are waiting for the approval of the OSC. Now, another important decision is where should we list? Canada's 3 primary indexes are the Toronto Stock Exchange, the TSX, the TSX Venture Exchange, and the Canadian Securities Exchange, the CSE. Now, dependent on what growth stage you find yourself in, each index offers a different type of investor exposure in addition to different cost structures. And really, this is a huge decision. I'm really skipping through a lot of this, but it's just a general overview. Like, these decisions can take weeks because we have to look at the listing fees. There are different fees for the amount of shares that we want to list and how long we want to remain on that. There are also a lot of requirements. So let's look at the requirements. So the listing requirements for the TSX, this is kind of like a quick overview, but essentially there are a lot. Say, for example, for our shoe company, we are a profitable company. The questions we have to ask ourselves: do we have pre-tax income last year of $300,000? Do we have pre-tax cash flow last year of $700,000? Do we have an operating history of at least 1 year? Do we have net tangible assets of $2 million? Are we going to, have at least 300 public board lot holders? Are we going to have a minimum free trading public float of 1 million shares? Is that value of those shares going to exceed at least $4 million? And do we have adequate working capital to really survive in the short term? If that is the case, then yet we don't even need a sponsorship, and therefore we can go with like that, and we can list on the TSX. If we don't meet that, then are we forecasting profitability. Are we a technology company? No, we're not, because we're a shoe company. We're not a research and development company. So in our case, the relevant options are either we're a profitable company, and if we're not, are we able to achieve that profitability? Do we have at least net tangible assets if we're unprofitable of 7.5 million? And in that case, do we have someone who can really sponsor us in our listing? Right? So that's for the TSX. And for very micro companies, the TSX is unrealistic. It's not a realistic listing. So then you can go one step lower. There are two tiers on the TSX Venture Exchange. Tier 1 is aimed at larger, more established companies, and Tier 2 companies are generally early stage or junior companies, which the TSX Venture Exchange believes need a bit more guidance than Tier 1 companies. The following slide presents the different requirements to be considered for Tier 1. So Tier 2, I'll provide a link in the video description where you can check out the requirements for that. But for a TSX Venture Exchange Tier 1 requirements, you have three breakdowns. You have industrial and technology companies, real estate companies, and investment companies. For us, we would kind of fall under the industrial technology kind of companies. In this case, we have net tangible assets of $5 million or $5 million in net revenue. Do we have minimum additional working capital of at least 200,000? Are we going to have at least 250 board lot holders? Will we have at least 1 million shares of free trading public float? Will the minimum percentage of issue held by public be at least 20%? And that means that the company and its shareholders, its internal shareholders, will hold 80%. And will the minimum share price of the IPO be at least 10 cents? In this case, we do need that sponsorship. So, we need to go to someone who's already listed on the TSX Venture Exchange, who's a Tier 1 company, and ask them to sponsor us and confirm to the TSX that, yes, they are a legit company and they have the interest to remain on this exchange. Okay? Now, for the Canadian Securities Exchange, the requirements are significantly lower because it is the lowest really exchange that you can kind of list on in the Canadian market. And so for the CSE, you really need to be fully reporting in at least one province, have a minimum of 150 public stakeholders holding a minimum board lot of 100 shares each, have a minimum of 500 shares publicly held. Freely tradable shares should be worth a minimum of $50,000. So our market cap, the minimum is $50,000, which in our case, we're a big company. This will not be applicable to us. We also have to have a clean record, no convictions for any officers, directors, and related persons, and must have a letter from market maker agreeing to act as a market maker. And so our market maker is essentially an investment dealer who buys and sells our shares in the CSE in order to provide that market for any interested shareholders. And so we need to have that letter from either GMP Capital or another market maker who will confirm that they will be our market maker if we do list on the Canadian Securities Exchange. Okay? Now, once we've listed, we've chosen our underwriter. We've prepared all the necessary documentation. We've gone to the OSC, and they've given us the approval. We've decided that we're going to list on the TSX Venture Exchange as a Tier 1 company. We've provided all relevant information, the term sheets. We've marketed the company, and then we go public. So what about life after going public? After becoming a reporting issuer, a public entity and its directors, officers, employees, and other related persons face a number of new obligations, primarily, but not exclusively, having to do with disclosure of corporate information to security holders and the investing public. These disclosure obligations are both of a regular periodic nature, like annual information forms, management discussion and analysis, annual and quarterly financial statements, annual and quarterly certifications, and annual meeting proxy circulars, and at a timely nature. So essentially, once we go public, we have a legal obligation to disclose our financial performance on a quarterly and annual basis and disclose any significant corporate events that might affect shareholders. And so this disclosure, this path of disclosure, takes a lot of time. We need to set up a legal department, and we need to spend a lot of money to really be in line with the compliance standards. Okay, so it is quite frustrating, especially if you are a private business who for years has spent minimal time on really creating these financial statements, and they were just more focused on just generating money, right? So it will be a change and a shock to culture, especially for a lot of long-term private companies. Okay. Now, escrow issues for IPO. This is something that in the US is a bigger issue than in Canada. And so fortunately enough for Canadian companies, it's not that relevant for a lot of larger companies. So in some IPOs, securities commissions require a company and its principals to enter into escrow agreements. The purpose of these agreements is to ensure the alignment of these principals with new investors by restricting the principal's ability to sell securities for a period of time following the IPO. In this way, the principals have an incentive to devote their time and attention to the company's business and to help ensure that the company's prospects in the post-IPO period are solid. Securities commissions generally do not consider escrow to be necessary for larger IPOs. Escrow is not required if a company after its IPO is classified by the TSX as an exempt issuer or has a market capitalization of at least $100 million. In addition, escrow is not required in connection with the IPO of a TSX Venture Exchange capital pool company. Security commissions will generally require principals of established issuers and emerging issuers to enter into a prescribed form of escrow agreement with respect to their pre-IPO security holdings. Long story short, escrow issues related to an IPO, if you are a very micro company, you don't have a lot of history in the market, and the security commissioners feel that maybe you're just trying to cash out right now, quickly liquidate your holdings, and then dump, this garbage onto investors. To prevent that, they set up escrow agreements in which, you can only sell your shares, a certain amount of shares within a 6-month period, right? So for the first 6 months, you can sell X amount, and then the next 6 months, sell another X amount, and so on and so forth. Okay, and so here are kind of the timetables for Canada. So for the established issuers, and these are issuers after an IPO, right? So you have for the date of the IPO, 25% exempt from escrow. So you can liquidate 25% of your shares, of your holdings in the first 6 months after the IPO. After the first 6 months, another 25% is released. After 1 year, another 25%. And after a year and a half, the remaining 25% is released. For emerging issuers, and these are very, very kind of sketchy people where, the Securities Commission really wants to be attentive to your holdings and liquidating your holdings, then they can release 10% in the first 6 months, the next 6 months 15, and so on until that 15% goes all the way and you can release all of your shares after 3 years. So it depends again on whether you are defined as an established issuer or an emerging issuer. And that comes back down to, going to your legal firm and your underwriter and determining, are we going to be considered one of these issuers, or are we going to be considered an exempt issuer? In that case, escrow issues do not apply. Okay, so here is a timeline for the listing as we've talked about it. In week 1, really, you select your advisors and determine who is responsible for what. In week 2, the valuation is conducted and the prospectus process is started. In weeks 3 to 4, you complete the prospectus, pick which exchange you want to list on. In week 5, you file the prospectus, and in Canada, you have to file in both English and French, and of course, get a proper translation in French. In weeks 6 to 9, you have to respond to any investor interest, settle underwriting strategy, and begin marketing the company in order to establish interest for the listing itself. In weeks 10 to 11, you market and engage interest of retail institutional investors at a serious level to really make sure that you have buyers once the company's shares do go public. And weeks 12 to 13, you complete all necessary documentations, and then shares begin to trade. So really, the process takes about 13 weeks once you are ready, once you've made a decision that, yes, I want to go public. So it takes about 13 weeks to go public. But again, it can take years before to set in the necessary precautions, so you become proactive and you set the necessary standards for a public company, and at the same time decide whether it is right from an incentive perspective for both the owners and the shareholders that are currently present in that private company. Okay? So going public in Canada can be very costly in both time and money. Before pursuing such an option, the business owner needs to fully understand the trade-offs that exist and commit before engaging underwriters. Consider speaking with valuation advisors and getting a rough estimate of the value of your business. Most of your wealth is tied up in this business. Determine what your exit strategy is as the owner of the entity and respond after consulting proper advisors. So it is a very, very lengthy process, but once again, once you seek that advice and commit fully from the beginning that, yes, I want to list my business, then you will proceed with that decision. In about 13 weeks, you can list your company in Canada. Other than that, if you have any questions, I do recommend that you can comment below, and I'll see if I can answer those questions. But if not, please do reach out to many of the law firms that operate in the corporate security space in Canada, and I'm sure they will be able to answer that question as well. If you found this video helpful, please like and subscribe to the channel for more. And as well, if you are interested in learning more about the financial markets, investing space, and researching public equities, then I do publish a lot of research on Seeking Alpha. So I do recommend that you check out my profile. I've provided a link in the video description where you can go and read some of my research. Other than that, have a great day, guys. Thank you.